So this is a session where you can hear about 3 ways of investing in sustainable business. And we have a lovely panel here. And I'd like to welcome everyone. And I want to get a show of hands about what brings you here. How many folks are interested in investing in sustainable business? Okay, we got quite a few investors. And how many people are interested in operating sustainable businesses? And we've got some of that same reflection on the panel here. So you're going to hear some stories and some expertise from our panelists here. I will just introduce our panelists by name. And we have to my immediate left, James Macon, Bob Barton, and Anders Ferguson. And each of us is going to briefly introduce ourselves before we speak. And the structure of our session is going to be that we're each going to talk for about 15 minutes and then field 5 minutes of questions. And we're going to do it a little bit different with the two on the left, your left. They're going to be talking about the same topic. And then we'll have a little bit of time for questions at the end. Is that right? Okay, great. Okay, I have my trusty egg timer. This is a slow living conference after all, none of this iPhone thing for me. Okay. So I'm going to go first, and I guess I have to.
There's a portable over there, Betsy.
So my name is Betsy Black, and I'm with an organization called the Co-Operative Fund of New England, and we're going to be talking. What my organization does is provide debt financing. And we've been around for 36 years, and we're a nonprofit lending institution. And I've been with the fund for about 4 years, previously worked in the field of CDFIs, which the Co-op Fund is as well, and just love the marriage of mission and money. And I've had the privilege throughout most of my adult life to move money around, both raising capital for CDFIs and then getting it out to sustainable enterprises. So I would like to talk about the Cooperative Fund, and I have some slides here. They're enormous. I've never seen them look so big. We are, how many people are familiar with loan funds or CDFIs? Some people, okay. Loan funds or CDFIs are a form of business, or they typically tend to be nonprofits, although not exclusively. And basically, they take money from investors and they lend it out for projects that benefit low and moderate income folks and other folks as well. And if you look at our structure, there's a very sustainable model at work here, and it is called diversification. If you look at where our loans go, we have food co-ops is about 1/3 of our loans. Housing is about 1/4, and we have other co-op businesses. Worker co-ops is another slice, and then there's nonprofits and what have you. So we tend to lend in a number of different spheres, which helps us have a diverse and therefore a safer portfolio. On the investor side, we similarly are diverse. Now, many CDFIs in this area, the Vermont Community Loan Fund, the New Hampshire Community Loan Fund, have a similar diversification of where their money comes from, and some CDFIs do not. I think that this makes for a stable, long-term organization. We've been around for 36 years. I'll make sure I actually got that thing going. And we take investments from individuals. I'm an investor in the Cooperative Fund of New England, along with some other similar funds. And one of my favorite investments is, see, the one up there is co-ops. We lend money to co-ops, and then they often turn around and lend money back to us as they succeed and generate reserves and need a place to put their money. We have just recently got our first government money. We're part of a pilot project with the SBA, the Small Business Administration. They've loaned us $1 million to lend to worker-owned businesses. And so we've been lending that money out to worker-owned businesses only. And then the other thing I think speaks to our stability as a lender and as an organization is if you look at this growth chart, which I'm not going to go into in detail, we started off really small, and now we're about 15 million. So we're a relatively small organization, and we've grown steadily over time, as has our portfolio. Next, I'd love help with the next slide. Oh, oh. Thank you. It's stuck. It's doing something weird. See if we can go backwards to the one you just had. And thank you for, I know this isn't your job. Okay. All right. Good, good, good. All right. Let me try again. Sorry about this, people. Yeah, I might. Huh. Okay. I appreciate your futzing around with that. I'm going to keep talking. So what the Co-op Fund does is we lend to cooperatives throughout New England, and we also, as was evident in the previous slide, lend to nonprofits. Basically, we're interested in lending to democratically managed organizations where the people involved have a vote in how the organization operates. We've loaned $26 million, and of those loans, 99.2% have been repaid. And that's over 36 years. That's everything from lending a few $1,000s up into the several $100,000 range. Oh, here we go. Great. If you look at that map, that is a map of New England and where our investments have come from and where we've placed loans. So there's quite a bit of diversification there. And we have paid our investors back 100%. The model with loan funds is you lend money with the agreement that you get a set interest rate, and typically the loan is for a period of time. The average is about 7 years. And it's a set interest rate. Our interest rate used to go up to 4%. We've lowered it down to 2% with the market being what it is right now. But it's a set interest rate, and the money is pooled. So my loan is not attached to XYZ Co-op. It's part of a pool, and again, that lowers the risk. So it's a particular type of investing where there's social impact, but the risk is mitigated, and it's spread around with the understanding that the investor is in congruence with the mission of the organization. And you can see the impact, 7,600 jobs and 4,300 units of housing over time. Okay, now I'm going to try this again. I'm going to have good juju with this thing. With the help of my friend. Thank you. Okay. When we think about slow money, and in this case we're talking about term debt. That's what we provide to our borrowers, and we provide term debt at a fixed rate. We do not do variable rate. Right now we are charging anywhere from 5 to 7% interest on our term loans that are generally 5 to 7 years. We have some flexibility there. And when I think about sustainable lending, co-ops really come to mind. And when you think, and here's some of the characteristics. A socially responsible business, a co-op has accountability. It's very hard to move a co-op, for example. They tend to be, they're place-based businesses. There are virtual co-ops as well. They're democratically owned and controlled. They focus on meeting needs before profit. They develop local skills and assets. They hire local people. They develop local people. They have an ability to assemble limited resources, and they're very difficult to move or buy out. I was just at the session where Equal Exchange was talking about their history as a co-op. If that company were to get a $3 kajillion offer from Starbucks, their bylaws or their whatever their articles of agreement are would require them to pay off all their debt and give the remaining money to a nonprofit. So they're actually structured in a way that is a huge disincentive. I mean, they just won't sell out. It keeps the company operating basically as it is. And so there's a lot of stakeholder loyalty. How many people here are members of a co-op? 1 in 3 people in the United States are members. In Italy, in one area in Italy, it's 3 out of 4. So there's a lot more involvement with co-ops than you might think. Now, I want to talk a little bit about my case study, and then I will move on. This guy is filming and advancing my slides, and I really appreciate it. This is the last slide. Thank you very much. Okay, so across the way over there is a big building that's being constructed. Anybody here from Brattleboro? A few people? Okay. So the co-op is partnering with the local housing group to build a 4-story building. It's due to be opening in the next few weeks, and there'll be 2 floors of housing on the top 2 floors, and the second floor will be the admin offices of the food co-op, and then the first floor will be the retail store. This is, as is the case in many food co-ops that have grown over the years, the admin offices are actually off-site, which does not promote a real efficient operation when you've got people running up and down Main Street back and forth from the store. So it's great that the admin's going to be there on site with the store. And so for the case study, and this is very typical financing. I wanted to show how the financing is put together. And I did get permission from the co-op to do this. One of the great things about co-ops is that there's a lot of sharing. It's sharing of what would be considered in many business environments to be proprietary information so that others can benefit from it. So this is about I'm just going to round for the sake of conversation. This is about a $10 million package of financing that was needed. And you can see a big chunk is from the bank. It's from People's United Bank. And then down the bottom you have CCF and CF&E. That's Co-Operative Fund of New England and the Cooperative Capital Fund, which is a secondary smaller fund that we have that we do some uncollateralized lending. Usually we do collateralized lending. And then so we put in originally about close to $800,000, and then recently we actually loaned $250,000 more for equipment, so you can bump that over. Then there was money from equipment vendors, member loans, which, correct me, one of you members, if I get this right, I think it came in about $1 million. Does that sound about right? And some gifts, some grants, and prior investment. Those are funds that the co-op has itself. And co-ops, typically when they get to a point to grow, they have amassed reserves that they can put towards an expansion. So this is a very typical structure for a co-op expansion. And also this is very much what you would see in a startup co-op. A lot of different pieces coming together, mostly either direct cash into the structure or debt. And that's I'm keeping it very simple, but just to give you a sense of how it would work. And the return is, so for example, for the co-op fund, the interest rate is somewhere between 6 and 7%. We have several different pieces. With the bank, I think it ended up being around 6. And the member loans, co-ops typically offer 0 to 5, 6% interest. So these are very modest amounts of interest, but they're for a very clear purpose. And when you go into it, you know exactly what you're going to get out of it. And then, of course, the non-monetary benefit is the security of having this resource in the community. So I'm going to stop now and field any questions that people might have. I'm just going to take a few questions and then we'll move on and hear about a different model. Any questions? Yes, Andrew. Great question. This sometimes we get this very question. And the latest answer I've heard is that some of it has to do with numbers. So 2 people is not a group. And 3 to 4 people operating as a worker co-op. They're different. I'm not versed in the legalities of different states. As far as some states, we don't care if you're organized as an LLC. If your operating agreement is that you're operating as a co-op where everybody has a vote and everybody puts in an equal stake, then that's what we're looking for. So it's not a technical requirement. It's more how you operate, and that operating agreement needs to be in place up front. I think Eric, did you have a question? It varies. For the Cooperative Fund, our structure is that we have an admin office, and then we have virtual staff that travel around New England. And my region is New Hampshire and Vermont. And my experience is in Vermont, people know what a co-op is. Generally speaking, there's not a huge learning curve on that. And in New Hampshire, much less so. And so I would do what I would say right now. I'd say how many people are a member of a co-op, and then I might go into more detail and ask them more questions, because many more people are members of co-ops and they don't even know it. And so that's a way to get to educate people and get them in dialogue about it, to understand the democratic nature of it. Because I do think that I still hear people say very fearful things about co-ops. And my friend Urban tells me it's from the Red Scare, that a lot of co-ops changed their names and really lost a lot of visibility because of the association of co-ops with socialism and communism and what have you, God forbid. So I think there's a huge amount of ignorance, but not so much in Vermont, in my experience. Other questions at this point? Yes? Sure. Some of the examples, for example, many rural areas, people get their electricity through an electric cooperative, and those are they're very different in how people experience them. Credit unions are cooperatives, and Ace Hardware is a cooperative. So, I mean, not that you'd be a member of it. The Ace Hardware stores themselves would be members. What are some other examples? Help me out. Cabot Creamery, yeah, is a producer co-op, and food co-ops. I can never remember. It's either UPI or AP. One of those two is a cooperative. Yeah. Yes. And I just attended a session where a guy from the credit union. What's it called? The 5 schools, 5 colleges. Thank you. And the statistics were that roughly 1 in 3 people in the country are members of credit unions. Okay, I'm going to stop for now. We'll hopefully have a little bit of time at the end, and we are going to visit a very different land, I think. And I'm very curious to hear what Mr. Macon has to say here. And I'm going to turn my little timer here, and I'll give you like a 2-minute warning towards the end.
All right, that sounds good. Can you guys hear me all right out there? Okay. My name is James Macon. I'm a managing partner at Closed Loop Capital. We are a traditional venture capital fund with what we believe is an innovative investment thesis in agriculture technologies and food system innovations. I am indeed going to be taking a hard left turn from the prior conversation. This is really a section that I'd like to pose a question about the role of traditional venture capital within sustainable local economies. And certainly I believe there is a role, and it's something that I would pose to all of you and would welcome in conversation over the course of the next 24 hours. Certainly we have seen significant capital innovation over the years as it relates to social responsible investing, as it relates to local investing, as it relates to industry and sector areas that are addressing social and environmental challenges. With that, we've seen the rise of slow money. We've seen Investor Circle. We've seen MRIs, PRIs, a number of different vehicles, the Flex Capital Fund emerging to address very specific capital gaps, very specific needs within specific industries at times. Again, what I'm looking to dive into a little bit is the other side of the coin, the traditional model, yet with a very specific investment thesis. To tell you a little bit about closed loop capital and myself, my background is entirely as a venture operator and venture investor. I've spent a significant amount of my career, probably 40% of it, within social and environmental ventures and as an investor in those ventures. My partner in Closed Loop Capital is also the founder of Greener Partners, which is an agriculture nonprofit based in Philadelphia that acquires land in the greater Philadelphia area and converts it into CSA-based farm models, uses that as a tool for community change. We're definitely coming at this with roots, feet in the soil, roots and experience in social and environmental venture. But what we're going after also is an opportunity to take a top-down approach and attract traditional capital markets to issue areas that are environmentally sourced and socially sourced from modern agriculture practices. I'd like to perhaps take a minute to define traditional venture capital. Is there anybody in the audience that is currently raising venture capital? Okay. Any venture capitalists in the audience? All right. So I'll take a minute just to demystify a little bit what we mean by traditional venture capital, because we hear about the capital continuum, we hear about the funding of different growth organizations at local levels and at national levels, and it's my belief and experience that there are various different trajectories, not just one trajectory that these organizations fit into. So for traditional venture capital, what we're really talking about is the financing of high growth, potentially high risk and high return investments. And this is in early stage and growth stage companies, backed by entrepreneurs, often by experienced entrepreneurs, with the ability to deliver a return anywhere in the ballpark from 15 to 25% plus IRR. That's internal rate of return over the course of the fund at 25% over 10 years each year. Qualifying for venture capital, what kind of deals, what kind of companies are appropriate for venture capital? And I think the big takeaway here is that very few. So the opportunity that I am going after is a very, very small sliver, and it is one that I spend probably 50% of my time telling entrepreneurs that come to me that they shouldn't take any venture capital whatsoever. The terms are not appropriate for them. The demands on the company are not appropriate for them given their market and their profile and their exit opportunities, which I'll talk a little bit about in a moment. What does it take? It takes very, very big markets, and it takes disruptive, often technology-based enterprises to attack those markets and to grow very quickly. When people hear this, it's almost the antithesis of what we're all here for today. There's not a whole lot of slow in what I'm talking about, which is why I probably was asked to be on this panel, because I think it's a little bit provocative, perhaps. But I do think, and I will put forth some thoughts on why it is important that we continue to support venture capital, both as limited partners investing in funds and for those entrepreneurs that are appropriate for it. To give a little bit of context with the profile of a traditional venture fund, which lasts for 10 years, it is managed by managing partners. The investors are typically institutional investors, high net worth individuals, family offices, endowments and foundations, at the bigger scale pension funds. And you'll see these funds ranging from anywhere from 10 million up to billion-dollar funds, to some of the big names that you see out there. For Closed Loop Capital, we are a fund in formation with a very specific investment thesis, as I mentioned. But that investment thesis is really grounded in those environmental and social challenges that are resulting from modern agriculture practices. So what we found is within our thesis, we are able to attack some of these challenges, but there also are opportunities for great economic gain for that 25% IRR. Now, to be specific about what we're talking about with this fund, we really think about it in 4 areas. One is on-farm technologies. If you think about waste stream management on the farm, if you think about energy, if you think about odor control, if you think about inputs in terms of pesticides, herbicides, all technologies, and with our lens of sustainability and addressing the key challenges that we face around health as it results from these practices, climate change as it results from practices on farm. All of these issues are key lenses that we put on it when we look at opportunities within those spaces. The second bucket is agribusiness operating systems. And when I say agribusiness, I could be referring to very large-scale, extra-large agribusinesses, as well as down to the small-scale farmer. And the types of things that we see there, we'll see a lot of stuff around precision-based technologies. We're talking about the tools driven by GPS, the tools that are allowing us to maximize yield in the field, as well as those tools that allow small, medium, and large-scale agricultural producers to plan for their seasons and, again, maximize yield. The key challenges that we face here are population growth, obviously, and being able to feed enough people, and natural resource depletion. So how do we do this in a sustainable manner so it gets back to net neutral with the soil, if not positive, so that we're actually adding to the soil through our practices. You can start to think about some of the no-till technologies, light-till technologies that we look at as well. The third area that Closed Loop takes a look at is supply chain innovation. Supply chain innovation comes in many different forms. There's opportunity for innovation and integration throughout the food systems. That is anywhere from slaughter, from processing to warehousing, distribution. The innovative models between all of those. There's a number of different entrepreneurs out there with exciting models that can be replicated across the country. In addition, we're finding a very crowded space in the web platforms that are connecting consumers and producers of local foods. I actually am a believer that the use of modern technology and the internet and social media in this fashion can yield great connectivity within communities, but at the same time provide opportunity to scale those businesses to a national or global level that represent very significant return profiles to potential investors. The final area that we look at is consumer products, and that is typically consumer products that have a technology backbone. If you do think about functional foods, to some degree, if you think about some of the processing going into organics, there is equipment and processes that have significant IP around them. We do take a look at that space as well. So that's a little bit of a profile of what we're up to about traditional venture capital. I would just like to posit that my belief is this is very different from a slow money approach. I do believe that Woody, and I've spent a lot of time co-creating with groups out of the slow money community and innovative capital models, especially for small scale farmers. The approach that we're taking is complementary to what I see in terms of slow money, what I see in terms of patient capital, investor circle. It's building connections amongst folks and doing grassroots level work to build those connections between investors and entrepreneurs. What we're doing is trying to attract those traditional capital markets to opportunities that address social environmental challenges and ultimately the soil, the health of us as individuals and the planet. VC-backed businesses can truly transform communities. VC-backed businesses can also be extremely dangerous to small communities. I've seen both. I've been part of both. Personally, having built, grown, and sold businesses, as well as be part of communities where we find VC-backed businesses that exit and are purchased by larger organizations and are relocated out of state. That has devastating impact. What we're seeing now, and has been underway for quite some time, are the structures in place to empower folks at the operating level and the governance level to control some of the potential outcomes there. The work that Jay Cohen-Gilbert's doing and Andrew are doing with B Lab, the B Corps, and B Corporation, officially recognized, are really great ways to protect mission and potentially build in some protection through exit and ongoing governance. Stewardship councils, there are many different forms of structure that you can take to support the potential outcomes that are socially and environmentally focused. So again, I think I'd just like to say in conclusion that there's so many attributes of local sustainable economies that are admirable. It's about resiliency. It's about decentralization. It's about trust. It's about connections. And I think there's a lot that the venture capital industry has to learn from that, which includes deeper connections with our investors, meaning as intermediaries, the funds themselves having deeper connections with our limited partners, as well as the natural roll-up-your-sleeves deep connections with the entrepreneurs themselves. So I think at that point I'll transition to you, or open it up to questions, right? Anybody? Questions out there? Right here?
I just realized, here. We got it. Yeah, they're recording.
Yeah, I don't know if this, yeah, it is working. Could you give an example? It's hard for me to imagine a 25% return on, say, energy management on a farm.
Yeah.
So could you give an example of what kind of a project might look for venture capital in the field?
So one very crowded area on the farm as it relates to energy, if you think about aerobic and anaerobic digestion, we're seeing a lot of activity there. There's some big incumbents. I should say that they are incumbents. They haven't been around that long. Harvest Power has been funded to the tune of $150 million by Kleiner Perkins and Al Gore with Generation Partners. These are plays on the farm where what they're doing is basically taking organic waste, and some of this is also being diverted from landfills into units where there's anaerobic and aerobic digestion processes. This creates methane, which obviously is a source of energy, as well as compost. Some of the really interesting models that I've seen are actually taking that compost and building on-site greenhouse facilities. So they're creating products. Mm-hmm. So you truly do get a closed loop system on farm. So that is an energy play. I will say, when I say energy, what we're up to with the fund is really going after market-driven opportunities. We are not so much about project financing. we're investing in teams of people who are building these companies that are able to scale and have strategic exit to deliver return to investors to the tune of 25% per year. Eric.
Thank you.
A question about the space of online platforms that support consumers and producers connecting online, those transactional platforms. I'm interested in your take on the role of food hubs in that dynamic, and what I've seen looking at that space is a potentially unhelpful impulse for proliferation of kind of not very powerful solutions to that. And so I'm just interested in how you would, in ways you could imagine talking to a player that's potentially an intermediary in that, and they could have the impulse to clutter the market with something that's not really very powerful, and maybe diffuse the resources that could be used more powerfully within the system.
Yeah, that's a great question, and what you described there is almost by definition what new markets look like, especially those that are venture-driven, where, to be crude about it, at some point in these crowded spaces where it's highly competitive, there are bodies everywhere. There are platforms that emerge as the go-to. And that may be multiple, but it will certainly be a small subsect of the ones that are brought forth and venture out. The question that I think you're asking is, are they helpful? In my experience, and being on the board of actually one of those type companies, it's a staged strategy. There's a lot we can do in building the connective tissue between consumers, producers, and those throughout the supply chain of the food system. Building a platform that allows for communication, for transactions, for marketing of products, I see as a good thing. But what's key, and I think relevant to your question, is in partnership with existing infrastructure, whether it's food hubs, whether it's local NOFA organizations. It's very important to have partnership model in place, and we've actually found that in the organization that I've been a part of.
Thank you.
Yeah.
Andrew.
So James, this is coming from a place of empathy, just so you know, and a way to share maybe best new practices in VC. And so I'm wondering if you could speak about your vision of what a socially responsible VC is like, different than a traditional VC. Mm-hmm. And I could be more specific, but I'll leave it open-ended for now.
To be clear at the outset, closed-loop capital is not defining itself necessarily as a socially responsible VC. And part of the reasoning there is because we are looking to make this as boring as possible from a how we do venture capital position, because we are trying to attract those traditional capital markets. That said, the entire opportunity that we're going after is rooted in those environmental and social challenges. And those are the challenges that the technologists, the scientists, the entrepreneurs are responding to with new technology, with new business models. In terms of what does socially responsible venture capital, or what could it look like outside of closed-loop capital, I think there's already some great models out there. I was part of CEI Community Ventures, making investments as New Market Venture Capital, part of that program, investing in underserved areas in northern New England. To me, that is socially responsible venture capital, but it's just one lens thereof. There are other venture capital funds that are focused on, they have a gender lens, for example. So I think the question, has so many different answers and possibilities, and I think that's part of what makes it so exciting.
Thank you.
Let's move on to our third example, and then we'll have time for more questions. So over to you, Bob.
Okay. Hello. Can people hear me here? Okay. If I'm too low, just raise your hand. So I'll say something about myself first. I have a lot of expertise, and my company, Catalyst, has a lot of expertise in the alternative energy space. We've spent about 30 years financing alternative energy and efficiency, primarily efficiency for us, and we're now migrating to the renewable space. We've been lucky enough to raise several $1 billion over the last years doing that, and been financial advisors on a bunch of projects. We've always looked at our investing as being triple bottom line as a social investor. So we make a point of, in the renewable energy projects we work with, there's a screen that we have to actually think that the company would meet a triple bottom line other than just a financial return for us. We are now moving like we've never been afraid of innovating, and we, as a company, a small company, there's 6 of us, we've started 2 financial products, one called performance contract financing and lease financing, which about 25 years ago didn't exist. And today, though, it's both of those products are about $4 or $5 billion a piece, and pretty commonplace. So one of the things that's motivated me currently as a social investor is to figure out how do we really actually work in the renewable energy space, because I'm going to tell you how it works and how we're working in it now and how it's pretty dysfunctional from a community point of view. So first of all, the energy space still has a huge opportunity. And different numbers have been bantered around, but the ones that I'm going to use today are coming from Bloomberg New Energy Finance, which I think is one of the better sources of numbers around the alternative energy space. And Bloomberg is saying that in the next 20 years, and hold your seat on this, $7 trillion will be spent worldwide on just renewable energy alone. So $7 trillion worldwide in 20 years. That's a lot of money. Now, to bring it closer to home, in the United States, we spent about $50 billion last year on clean energy, and of which about $20 billion of that was in a form of financing called project financing, which I'm going to talk about because that's actually one of the problems. It's an opportunity and a problem at the same time. So there's a lot of money that's going to be spent, and my fear is that it's going to be spent and the returns will go basically not to any normal non-accredited investor, but only to pension funds and large institutions. And that's where one of our challenges is. There's a huge opportunity also in the energy efficiency space. A group called ACEEE, which is American Council for Energy Efficiency Economy, says that $250 million will be spent. I said million. $250 billion will be spent in the next 10 years on energy efficiency. That's the space that we've really been in and have done a few billion in. And so I imagine that's a real number. So my back of the envelope is that in the energy space, in the next 10 years in the United States, we will probably spend, hold your breath, $1 trillion. $1 trillion in the next 10 years are probably going to be spent in clean energy and energy efficiency. So it's a big number, and yet we're counting on the traditional capital markets to do all of it. And that's going to leave out basically most of the people in this room, including myself. Except I'm coordinating it, so I do get it. I get it in a different way, but I want to see it go a different direction. So what do we do right now? Well, one of the things we do is farm methane, which is what Jason was talking about. We're looking at renewable energy from solar, wind, hydro. We're closing a hydro transaction right now this month for about $10 million. We're looking at the farm side because, as Jason said, there's a lot of win-wins there. You're solving manure problems, you're getting fertilizer, you're getting bedding, and you're getting energy. And the returns can actually be quite good on the project finance side. Our core clients basically are developers and the person who's putting in the alternative energy. That's really who our client is. So they bring us a whole different group of clients. They bring us institutional clients. It could be hospitals, it could be public sector, it could be commercial. So we really are serving the people who are putting in the renewable energy systems, and they're called EPC contractors, developers, they have a lot of different titles for that. But that's our core audience. We, as a company, are focusing on what we call community energy, and that could be defined in different ways. But for today's discussion, I'm defining it by size. And that size would be, as a project typically, that's about 5 megawatts in terms of power or less, or $20 million in size. And the reason we've chosen $20 million, and that's not an absolute number, it could be 25 million, is that that's the area which is really underserved. So when we start talking today, and I'll tell you where the money is being spent and how it's being spent, that's the market that nobody wants to be in, and so that's the market that's the hardest to serve. That's in the alternative energy space. The 20 million and less is actually community capital. So it's a big number when you're talking about $50,000 or $200,000 transactions. But in my space, that's really the space that's underserved. The way we serve customers and the way the renewable energy sector is financed is two ways. There's balance sheet financing, and it's called project financing. So balance sheet financing is just as it sounds like. You take the strength of the balance sheet of the corporate lender or of the public entity, and that's what decides how much money you can get. And then project financing is a different animal and is actually dominating the whole renewable energy space. And that's where you don't take the balance sheet of the company, but you actually start a special purpose corporation, so that's the structure, a new co, typically a special, and then that special purpose corporation, when it started, the only assets it has is the contracts that it has. So it could be a solar PPA, it could be a ground lease, it could be a whole bunch of contracts to put together this financing. But it doesn't have a lot of money. It may have only a little bit of developer money in it. So an investor who wants to lend or invest in that special purpose corporation is taking a higher risk than if you were doing balance sheet funding. So the question becomes as well, why is project financing, which it is, dominating? Well, it's the only way that developers can really do projects, because the developer, if it had to basically guarantee every loan it would do, would soon get up to the place where you've got $1 million in net worth and you're guaranteeing maybe $2 or $3 million, and then nobody will lend you money. Whereas if you use the project finance structure, you're able to basically not use your balance sheet and then fund it into a special purpose corporation, and then it lets developers be able to do multiple projects without having financial limitations. So in the United States and worldwide, project financing as a finance tool, it powers about 90% of all the renewable energy that's going on. And it's not just renewables, it could be efficiency, it could be funded that way as well. So it's a mechanism that's important to both understand and replicate, because here's the challenge. So if you want to use project financing, which is what our company is using now, what do investors want? They want typically 5 things. One is they want a project to be $20 million or more. Now, there are some exceptions, so some will go down to 10. They might really break their backs there. But others are way higher than that. MetLife, when I spoke to them last week, their very minimum is $50 million. So I'm using 20 as the minimum number, but it's a pretty big bar. Second thing they want is they want large, investment-grade contractors. They want contractors that have that are strong financially and are very, very experienced. Third thing they want is they want the contractor to be getting what they call an EPC contractor, an engineering, procurement, and construction contractor that is investment grade to do the installation for them. Because typically when these things are done, somebody will guarantee to the developer that we will put the system in on a fixed price at a certain amount of time, and if they don't, they get liquidated damages. So now we have a $20 million minimum. We have a really big contractor. We have to have a really big, strong EPC contractor. And then the requirement is you have to have very strong credit, a person who wants to buy this energy. So that tends to be, public entities, colleges, universities, and large corporations like Whole Foods and Staples. That's where the renewable energy business is right now. And that's what's happening when I say there was, $20 billion done in project financing last year. That's mostly where it's happening. So that leaves out, quite frankly, most of Vermont, all of New Hampshire as well, a good part of Massachusetts, and a lot of that's happening in New England, because we don't have projects. I'm estimating, and our company is estimating, that 90% of the projects happening in New England don't meet those standards. So we have a problem. We have a real disconnect because the only projects that are going to get built right now and financed are in these standards because that's where the money is. And there's billions and billions of dollars of money waiting to fund this kind of stuff. So that creates a challenge and an opportunity, and in fact, that's what Anders and I have been talking about. And we don't have solutions, but we've been starting to think about how do we deal with that. And so with that thought, I'll turn it over to you to start some brainstorming. I think we're going to do questions right after Anders talks.
Yeah. Hi, I'm Anders Ferguson. I'm a partner at Veris Wealth Partners. We're sustainable and impact advisors to families and foundations. We help them make meaning with their money. We're a national firm, offices in San Francisco, Boston, and Portsmouth, New Hampshire. I live in Shelburne Falls, Massachusetts, unlike my title there that says New York City. Bob and I worked together for 4 years from 1988 to 1992 and have been friends for decades. And you know, Bob helps us think it. We're lucky to have people like Bob in our life at Veris to help think about these kind of issues that our clients and opportunities, who they obviously want to be involved in renewables. So Bob put the number of 7 trillion. Now that's global. So there's some subset of that, which is the U.S. The reason I asked Woody this morning, or this afternoon, what is 1% of a million, is because I don't think vague goals actually get you anywhere. I think this is a very specific challenge. Now, depending on what million people these are, because to the best of my knowledge, something like 30% of Americans have no net worth. Maybe it's 40%. I don't think it's 65. But it's a big number. So if Woody is including all of those people, then it's hard to know exactly what that million people have as net worth. But let's say these people have $250,000 in net worth, including their home, which is not exactly unusual. Make it 100,000. At 250,000, that million people is $2.5 billion, which we want to deploy. I think Woody wants this done in 10 years, and we have 17 million deployed. So that is a lot of work in front of us. Now, Bob has laid out an area that I think all of us would argue that part of food is energy, and part of slow food is community-based projects and institutions. And so part of what Bob and I have been puzzling through in this over 6 or 8 months now, as we ponder through the slow food part of the picture, and sustainable food and agriculture, and the great desire. We have lots of clients. I mean, this is a very real trend. We can report lots of clients and prospective clients and lots of other people that really want to invest in their communities. They want to invest in sustainable food and agriculture. They want to do it, they think, in a slower way. And then when you actually get granular with that, the reality is that most people will never make a private investment. They're risky, they're confusing, they're really tough to do. So a lot of the strategies which our movement has created are really probably unlikely that many of us will ever do. So then we ponder and we look at this and we say, well, you've got all the needs in the sustainable food infrastructure, which James has also has talked about. You have a lot of needs in the agricultural side and the whole system, which will require hundreds of billions of dollars, arguably, over the next number of years. And then if you come specifically to Vermont, where Bob lives and I live right over the border, a mile from it, so sometimes they at least let me in the state. This state, much like Massachusetts, which is a larger state, which has set a similar kind of vision, but let's take Vermont, where it's very, very specific. And they have set specific goals of 20 and 40% renewables and local food in very short order, the next 10 to 15, 20 years.
which even for a state of only 550,000 people is going to take hundreds of millions of dollars to accomplish. So our concept of this is to see what kind of institutions is it really going to take to do that, how we could create institutions that both got the job done that Bob has outlined here. How do you get the distributed renewable energy projects built that are owned by communities or part of communities or on farms or attached to hospitals? How do you actually do that on a really pragmatic basis, which are meeting needs of investments under 20 million, which may be larger than a lot of us conceptualize, but are still very small amounts in the world of institutional capital, as Bob has discussed. And then how do you do local, so if you kind of add up the challenges, how do you invest in this new sustainable food system? How do we meet the needs of people that really want to do this? Whether they're an average person, a high net worth individual, maybe they're a state pension fund that realizes that if it reinvests in the state of Vermont in these food and energy questions, it might actually be great for Vermont and for their pensioners or insurance, people that are buying insurance from them. Maybe it is Middlebury College or Dartmouth or the University of Vermont. It could be many players that have never entered into these areas because they never kind of conceptualize investing being necessarily sensible to do in their local community as we increasingly sped up money, as Woody talked about today, into markets that we have no idea where our money is. So, in brief, the conversation which Bob and I have had with many other people at this point is, even in the state of Vermont, we're going to need hundreds of millions of dollars of mobilized capital. We already know that in many cases there are not capital markets to actually provide that capital. So somebody's got to help design a system that is bigger, stronger, more resilient, slower, localized, however you want to put these words on it, that will undoubtedly include on one part of it venture capital and on the other hand community loan funds. But somewhere in the center can a new flywheel actually get created that starts addressing the kind of capital that's going to have to be created to build this slow life, which we're pondering its creation, this more resilient life. That's been the pondering that we've done. And I think kind of the challenge to ourselves and to our state to look at this in a way that will ask us, you know, what's the scale of doing slow if we're really serious about it? And how can we build the kind of infrastructure that connects all of us as consumers of energy and food and local and who have money, who have little money, who have institutional money. You know, there is a way to ponder our way through it. There is a way to likely be able to do this if we're serious about it. Thanks.
Sure. James wants to jump in, and then we'll have time for some more questions.
Yeah, I just wanted to follow up on something that Anders said that I think really rings true. I believe at the institutional level, when dealing with communities and trying to engage them, what is probably needed at this point is someone or some entity to be able to present the true opportunities for those entities. So he brought up, you know, whether it's insurance companies or the pension fund. Well, let me give you an example of Fletcher Allen Healthcare. I mean, imagine making the connection between health and food, right? I think they're actually doing a great job there, very similar to the path that Kaiser Permanente is on. The opportunity for a place like Fletcher Allen could be influencing their supply chain, gaining control over their supply chain of the foods that are coming in. increasing the amount of local foods that are being fed to patients. The challenges that they face are, we need 600 pounds of carrots every week, and they need to look like this. And they can't do it in a fragmented manner, going around to all these small farms individually, or even small processing facilities. But the opportunity there is for them to think outside the box in terms of a processing facility, that they could have ownership within their supply chain, greater control, greater transparency, greater efficiency, and upside. So I think that's a great point.
So I wanted to say something that we take questions too. Is part of the opportunity for investing is on the project finance side. You have this special purpose corporation, and it has two sources of capital: debt and equity. It's hard to get the debt because the entity has no borrowing history and it doesn't have any assets except contracts. So you have to be that's why when I outlined the 5 things the investors want, is that you have to be, typically for these projects, it's often 70%, 80% equity and 20% debt. And for the projects under 20 million, almost all the time it's 100% equity. Now the returns are good, and from a social point of view, we're in a situation where we can actually have a choice about whether we want to take less returns. Because the institutional investors and the people that are investing in the types of projects I've been describing are getting pre-tax returns on equity of 15 to 20%. And in some states, because of the laws, the regulations, the way in which SRECs are sold, or the floors, or the RPS standard, the Renewable Portfolio Standard, places like Massachusetts, New Jersey, and Hawaii, I mean, rates for return without being a venture investor, which is a lot more risk, we've seen things at 40% per year, over 10 years. So I don't think that from a risk-reward point of view, it's obscene, quite frankly. So but when there's no other source of capital, you have to basically be able to do what you have to do. So I'm saying there's a huge opportunity to actually make a reasonable rate of return, whatever that is defined by different people. And it doesn't have to be the situation where we have the mentality that we want to invest in renewable energy or energy efficiency, and we're going to do it at below market rates and take higher risk. Well, I want to eliminate that. We don't have to do that, because that isn't the market. Yeah, Kathy.
I obviously don't know your space the way the 3 of you do.
Can you speak up a little bit? Press it until the green comes on.
Okay, can you hear me now? Okay. It seems like asset-based lenders would be interested in this space if they're backed by contracts. I mean, isn't that what asset-based lending does? That weird middle market of lending. I mean, aren't the contracts an asset that could be?
Yeah, but it's an intangible asset, and an asset-based lender typically wants a tangible thing like inventory or other things in which they can repossess. So if you have a renewable energy project, it's true you could get a turbine, or you could get, but the value of repossessing used energy equipment, like particularly solar panels, given solar keeps plummeting right now, and
right.
I mean, just think if you were a lender to solar panels 5 years ago, it went in, at $7 or $8, and now they're going in at $4, and there's no question they're going to go in at, $3 by the end of next year probably. So there's not much asset there. The asset-based lenders won't touch it, unfortunately. But it's a good suggestion, and everybody should give more suggestions. I think there's a role, quite frankly, from a community level. Hey, foundations should come up with some grant money to provide technical assistance so our local banks can understand this. Because I can assure you, there is not one local bank in Vermont that knows how to do project financing. Now, we have some regional banks like TD Bank that can do it, but the people in Vermont and TD Bank, they don't know what to do. They're going to have to go back to one of the major offices because we haven't done that here. It's not like they aren't smart. They just don't have the skill set. So we have family offices that could do things. They could provide debt money, just like individuals could provide debt money. Certainly foundations could provide loan loss reserves on the riskiest deals if it has high social impact. There's ways that we as a community have to start thinking about how do we take our assets and make it happen. And then there's room for everyone else, smaller individuals who I imagine, like the debt investors in these deals, typically get 5 to 10%. I would imagine most people in this audience would be very happy with, 5 to 10%, given what we're all getting, or not getting. And you could do it, and you could localize that. So it's going to take a lot of work, and that's what Anders and I we haven't come up with a solution, but we said we know that it could happen, and we're hoping that local people want to be part of the solution and not just leave the answer to regional money banks and large pension funds and all the guys that are making extraordinary capital. So whether people locally want to make the same returns as those investors, that's fine, or other people would make decisions to take less and give some of the profits back to the community. So maybe create a nonprofit and say, great, we don't need to take 25% rate of return. We'll take 15%, and the other 10% goes to a nonprofit that's going to do work development in local colleges or something. I mean, we just have to start thinking about this in a way that makes sense and not be greedy, Eric.
Thanks, Andrew.
So this is a question for Anders that follows up on what you were just saying, and thinking about this idea of designing a system that would support a slower life and the scale that's necessary to do that. Who would you imagine some of the stakeholders would be that would participate in that design process? So I feel like you mentioned some in your last comment, but just to ask specifically, if you were starting to bring together stakeholders to engage in that kind of design process, what might that look like?
Well, I mean, in essence, you have to have the discussion with people that either have the capital or potentially can speak for the capital. So it would be good to have some community dialogue about what this would look like. For instance, there's a whole movement in many states now of people that are looking to replicate what North Dakota did 50 years ago in creating the Bank of North Dakota. And it's a state-owned bank which very conservative Republicans and very liberal progressive Democrats love. And so that's in part been a community conversation that's over time. So, but if I don't want to leave the community out, because obviously we're critical in this. But and then there are all the existing capital holders that and I think a critical part of that is to have a conversation with particularly the alternative capital providers, whether it's the Flex Fund or it's the Vermont Community Loan Fund or the Community Foundation or local community development corporations, a whole range of those vehicles. So that they can see their role in this. And then there's the insurance companies, endowments, foundations, pension funds, and institutions, including the state of Vermont, that all really need, and I think James said it really well, there is a business case in all of this. You do not have to be right or left to get the clarity of this. And that is, I think, going to be where a lot of attention. It's not going to be fuzzy-headed. And I think when it comes to this capital question, we have just completely gone fuzzy on it. I mean, how many people remember when there was a savings and loan bank in every community? That wasn't so long ago. Those savings and loan banks were they were mutuals. And what happened to them? They all got rolled up in the 1980s because it's not hard to roll up banks. It's really pretty simple. You don't even have to be that smart to do it. And they all got rolled up and they all got thrown away. So we have, if you look at the community wealth that we have in this country, we have systematically taken it out of communities and sent it somewhere else. As Bob said, even to regional banks like TDI, we don't even have the capacity to do this anymore. You have to go to Albany or Quebec or someplace else to do project finance. So it actually is taking on this question of where capital comes from, what our resources are, and getting serious about it. Credit unions can play a role in it. But the question is, are we serious enough about this to create capital again like we used to? Or are we going to wish we could, hope we could, and the march will go on because the money centers will march on. They do it every day. And they'll pass laws to do it, and we'll create investment tax credits to build a renewable future, and the vast majority of those will go to corporate investors, institutional investors, and very high net worth, very wealthy people who can take advantage of them. Almost none of that benefit will go to the state of Vermont, residents of Vermont, or institutions of Vermont. So, but I think it's a practical, as James said, what's the business case? And then it's the courage to do this. And I think also the courage of all of us that have kind of taken these alternative approaches to realize that it might take something bigger than we've imagined. And it's funny because in lots of cases, our forefathers and mothers, they had that courage. They built huge systems that were owned by people. In fact, you can go look at large cooperative economic systems just over the border in Quebec. You can go to Spain. You can look many places. They can work. They don't have to work exactly like that. And I think that's going to be the challenge that we're going to have. Are we willing to imagine something that we once had and we have to have again? But as James well pointed out, there are enough institutions just in the state of Vermont to figure out where you would aggregate several hundreds of millions of dollars. And there are also organizations like the Community Loan Fund and Community Foundation and others that have already aggregated hundreds of millions of dollars. It's a doable deal if we can just see it and not get scared by it.
Thank you.
Peter, yeah. Why don't you say it and I'll repeat the question if somebody doesn't have the mic.
Michael Schillen was talking here a few months ago. He said that there was about $5 billion in Windham County alone invested in IRA funds. And I'm wondering if you have any huge number. I'm wondering if you have know of any strategies for, I've heard of self-directed IRA funds, for people to get that money out of these national investment vehicles and into local endeavors.
I've been asked that question before. So I have a self-directed IRA. I have a 401k as well, but I have invested directly with my money into private projects. But I'm told, even though that it's taking the money out of the IRA, if you put it directly into a community business or you make a loan, it's actually a violation of the SEC laws, so that unless you're an accredited investor. So the only way it would work is if you have an IRA that's self-directed, and David may have some more information, you could put it into a revolving loan fund, for example, or to a nonprofit or some structure that will be doing the re-lending. And maybe Andrew has another way to do it. You have to find it, sort of like Soldalgo was telling us here, hey, they're going to start a nonprofit. Oops, sorry about that. They're going to start a nonprofit, and people would be able to put money into that. Well, that would be an example where your self-directed IRA money could go. You just have to find the legal structure.
On the self-directed IRAs, I work for an investment firm, and there are some custodians. Pensco is well known. They're in New Hampshire, and they're in San Francisco. Okay. Pensco is in San Francisco and New Hampshire. And there is a lot of flexibility. The key is, though, when you're setting up a loan from your self-directed IRA, it has to have a equity or a loan component to it. So you might be investing in a local business, and that business is giving back a promissory note that I'm guaranteeing you 5%, or you could have an equity share. And there are more and more people who are seeking this out after having been burnt in the market, and they're saying, I don't want to invest in mutual funds. I don't want to invest in stocks. They don't want to do bonds. So there are opportunities, but it is high risk. And you've got to be willing to know that this is your retirement money, and are you willing to have that level of risk on it? So
Let's have a comment
Can
from
I-
Andrew, and then
yeah.
I want to make a call for action.
Yeah, so I also work for an investment firm, And I've had this conversation with Betsy and Co-Operative Fund of New England also, and that is, how do you get retirement money into these projects, right? And I believe, and I'll defer to David Hills also, who may have looked into it, that I'll just explain first. IRA money is held with brokerage firms, custodians, as we call them, custodian banks. The biggest ones are for retail are Schwab, TD Ameritrade, and Fidelity. Okay, we use Pershing. Institutions use companies called State Street, for example. Okay, they hold the stuff. All right, that's where the stuff is held. So basically, they're the gatekeeper, and they have a fiduciary responsibility. And if you can get the deal on their platform, then I believe you can invest IRA money, especially if you have an advisor who is advising you on it. That's the way. But it's a little cumbersome, and obviously the deal has to be big enough to be worth the legal work to create what's called a private placement memorandum and have that approved by each custodian. Each custodian would have to approve it. But it's actually not that expensive. I mean, I looked into it and a lawyer doing that work. So if anyone wants to talk more about that, I'd be happy to.
Okay, great. Thank you. So we've covered quite a bit of territory here in terms of risk, return, markets, the future, aggregation. How many people here are currently doing something to in this arena, either personally or professionally? Raise your hand if you're willing to do something more, whether it's to have a conversation with these gentlemen here, to increase your own investment, to take a step that moves us forward. I think that that's what this is about, because one of my jobs is I'm a life coach, and we can talk and talk, but we best be acting. And so there are a number of vehicles that are available to all of us right now that we can act on, and then we've also got to, working in the micro and then the macro as well. So thanks very much for coming. I think I see a last comment here. Are you talking about energy? Yeah. Oh, okay. Yeah.
Yeah, I think there's a huge opportunity there. I actually worked for a biocomposite manufacturing company, a Cornell-based technology called E2E Materials, annually renewable fibers and soy-based resin system, creating sheeting goods for home building. So I spent a lot of time in that space. From a technology standpoint, there's a tremendous amount of opportunity for somebody who's coming at it as a builder, aggregator of projects. I think Bob can probably speak to that. I will say, however, on the technology side, I've spent some time with Kevin Surace and Sirius Materials, and it's not looking so hot in terms of the windows that they've created and the drywall products that are considered energy efficient. So you just need to be careful about the technologies that you choose in that space, because there is, in my experience, a little bit of smoke and mirrors.
So I think the practical side is, there's almost in every state. I don't know, particularly Connecticut, but at one point it used to have the Clean Energy Fund, and now it's morphed into something else. I think it's the Clean Energy Finance Authority. So they probably have a finance program under them. In Vermont here, if you were a home builder, you have dozens of places where you could go to get money to help your customer, the residential customer, get money for energy efficiency improvements and upgrades is what you're really talking about. In Pennsylvania, which we've done a lot of work with a group called AFC First, and they have done about $50 million as a private company, just doing nothing but energy efficiency improvements in PA. So I think you just have to know the geographic area and do some research. Contact your state energy office, and they'll be able to turn you on. I mean, obviously there's banks that will do it, but I would find a specialty lender that really cares about it, because they'll work with the contractors to actually do, so the contractor can do some of the paperwork right at home. Okay.
That's tough from a venture capital standpoint. Scalability is extremely difficult on the time frame that the demands you would be under. I think from a project financing standpoint, there's probably some more opportunity.
So I think it's time to move on to the party part of the day. Thank you all very much, and everyone can stick around a little bit if anybody has any more questions, but thanks very much, and enjoy your evening.
All right.